Okay, so my name is Justin Vautier, enrolled agent, owner of Roth Tax Professionals. Today, I want to talk to you guys about tax-free retirement. About maybe 3 or 4 years ago, I read a book. It was very, very intriguing. It was called Tax-Free Retirement. And what it essentially proposed is that the tax rates and what we get taxed on as far as our income goes is we don't know what the future looks like. However, the way things seem to be trending is tax rates go down and then they go up, and they typically go up more than they went down previously. And what I believe, the way things I believe will go is they probably will continue to move forward into more of a tax model similar to that of the European, Europe or someplace like that, where taxes are actually pretty high. Now, I'm not insulting it. Benefits are very good as well in a lot of places. And so there could be a benefit to that, but that's not my area of expertise. My area of expertise is taxes and actually advocating for as low tax as possible. That's the perspective I come from. And so I'm always trying to come up with ways to help my clients pay less in tax. Many of you are familiar with LLCs and being taxed as an S corporation. That's been my shtick for the last 12 years, and it has benefited a lot of my clients and has saved probably millions of dollars in tax liabilities for my clients over those years. But another big conversation is, okay, well, what are some of the other nuggets of tax savings that people can potentially take advantage of similar to that? And one of those is the strategies that were proposed by this book, Tax-Free Retirement. You probably are familiar with some of the retirement account options. There are deferred retirement account options, and there are what's called Roth or after-tax retirement options. It's essentially 401ks, simple IRAs, SEPs, those kinds of things are what's called a deferred or traditional IRA or deferred tax. That means you put money in now, you get a tax deduction, and then when you retire, you take that money back out, and it ultimately is taxed at whatever tax rate you are at that time. And so if you think that in the future you're actually going to be in a lower tax bracket than you are now, then doing a deferred tax kind of plan is the best for you. And so I would recommend that you do that. But if you think that you are going to continue to build wealth, that you are going to continue to be able to generate more money than you did the years before, and in the future when you go to retire, you're going to potentially be able to if you're going to end up being in a higher tax bracket, then you will want to do something that is a post-tax, meaning pay taxes now on it, and then in the future, you don't pay tax on that again. So that is part of that tax-free retirement strategy, is to invest in those kinds of accounts. As far as my feeling about whether or not taxes are going to go up, yes, I think that there's a couple of ways that we're dealing with the trillions of tax debt or trillions of debt that we are in as a nation. Taxes is going to be one of those, but also inflation is going to be the other one. Putting money into the economy and essentially making the dollar value less so that our national debts are lower. But that's also that's another reason why you want to invest in equities and other assets such as real estate and those kinds of things, because you can then hedge against inflation and whatnot. So some of the post-tax tools that people use to invest in retirement accounts and then not pay taxes in the future are, number one, a traditional Roth IRA, which is for people who can put away $5,000 to $6,500, depending on your age, into a traditional Roth IRA every year. And then when you go to retire, you can pull that money out and it will be tax-free. Essentially, you are that is by far the best return on your investment um, that you can get. People oftentimes don't recognize that, yeah, maybe they're getting 10, 15% return on their investment at the time that they contribute to a traditional IRA because they're not paying their regular income tax rate. But think about all of the money that is going to be generated over the years, maybe doubling, maybe tripling the money that you invest now, and then the IRS is going to come and take 30% of that. And so that's a huge reduction in your return on investment. But Roth and post-tax retirement types of funds, it's not taxed in the future. So you've got all of these earnings, sometimes tripling, doubling, tripling, and then finally you go to take that money out and you don't have to pay taxes. So I am all about those kinds of tax tools, those retirement tools. Take advantage of those, invest in those. There are also 401k plans that can be converted to Roth. It's a complicated conversation, and in fact, I'm not really a specialist in that regard. I actually refer my clients to other CPAs or financial advisors that are very knowledgeable in that kind of thing, and would better be able to advise in regard to structuring 401k plans and whatnot. Now, my favorite is what's called universal life insurance policies. And this is, I've been told, they're complex. They have to be paid attention to because those kinds of plans can go south. So universal life insurance is essentially what happens is it's an insurance policy in which on a monthly basis you pay into an insurance company, into an insurance plan. Part of that monthly payment goes to a life insurance policy, and part of that goes into a money account or an investment account, which grows based on whatever the company determines the growth is. Now, I have recently discovered a company, Minnesota Life, has an interesting policy in which they invest your money into an index fund, and then there is no cap on the growth. So if the stock market is doing really well, then the growth will do really, really well. But there is no losses generated, or there is a bottom. If the stock market is going down, then you will not lose money. And so therefore, those assets are protected when you invest in those. And the only thing that is affected is whether or not it grows or not. Now, historically, over the life of the stock market, there has been 10% growth year after year. And recently, I think over the last 10 years, it has been 8, and maybe it will go lower, but you can't get much more of a secure account than that. So what happens is every year you invest in this account and it's paying this life insurance premium, and then it's also growing a cash account that increases in the amount that it's making year after year. When you go to retire, essentially, you can take out all of that money that you invested in, as long as that life insurance policy stayed in place and it's tax-free. Essentially what you're doing is you're borrowing from the account. You can use it for retirement, and then when you die, the life insurance policy will pay that back. So you never had to actually pay tax on that. Why that's really helpful is that it has no limits to the amount of money that you can invest in that account. If you want $1 million, if you want to retire at $1 million, if you want to retire at $2 million, you can invest in those accounts, and you can pay into it on a monthly basis based on whatever the advisor, the financial or the insurance company states you can put that in, and then in the end you can pull that money out tax-free and it ends up getting paid off. Or you leave it in there and your beneficiaries get the money out of the account and the tax and the life insurance policy. So it's a combination of those two. Now, so for people like my age, 40, 50, 60, you're going to have to pay a lot more in now to benefit you in the future. in order to get to those numbers, to $1 million retirement life life policy and that kind of thing, being able to take $1 million out at retirement. But what this gal, her name is Cheryl, and I'm willing to give you her information. If you want to call my office or email me, I can give you that information. But she approached me about it, taking into consideration my kids. And this is really good for people who have children. And it's going to be intriguing. And to me, it's a no-brainer that this is something that you're going to want to do for your kids. Essentially what it is for $99 or $100 a month, I can invest in a universal life insurance policy for my children, for my daughters, 3 and 5 right now. And I do this for 20 years. So it's about $1,200 a year for the next 20 years. I invest something like $24,000 in, and I now no longer have to invest in that account. And then when they go to retire at the age of 60 or 65, they'll be able to draw about $80,000 out of this account tax-free until they are 100 years old, if not longer, and still have money left over in the account to pay for death benefit or death expenses and those kinds of things. So what it is based on that is, and I'll repeat myself, you pay $100 a month for each of your kids, and by the time 20 years goes by, you stop paying that, and they can retire on $1 million retirement. And so to me, it's like the best gift you can give anybody. And I'm not making any money by referring these out. I'm just sold on the idea. The caveats are, it's something that you have to be really careful with, because you don't want to get some cockamamie financial advisor saying that, oh, I can manage those funds better, or maybe you have to be careful. Even I've heard some horror stories of a spouse encouraging the other spouse to cancel their life insurance policy and take that money out. When you do that, all that money becomes taxable, and you have lost all of the advantage that you have had by getting started early and then just being very consistent with that. Your kids too don't even have to wait until they're 60 it's your life insurance policy. You dictate what they do with it. But if they decide, well, we want to use it for college, or we want to buy a house, or we want to do A, B, or C, they can do that. But think about what 60 years of accumulating interest and compounding growth could do for for a child that's under 10 years old. If you invest saying near $24,000 into an account over the next 20 years, and then it grows for 30, 40, 50, 60 years, it's $1 million. And that's just the way compounding interest works. And the kids are going to be able to benefit. It's probably the best thing you can do for a kid. So if you want to know more information about that, I would recommend calling my office. I'll refer you to Cheryl. She's amazing. And again, $99 a month for your kids, give them $1 million retirement. I mean, you can't ask for anything more, and it's secure. So as long as you're paying in and somebody doesn't liquidate the account, they're safe. You do need to make sure that you pay attention to it, that you pay attention to any changes that there might be to those kinds of accounts. Stick with the company, stick with the insurance broker, make sure that you pay attention to those. But in the end, I don't think your kids could ask for something better in that regard. All right, well, thank you very much. I'm going to go ahead and continue with the regular scheduled mastermind meeting, but I wanted to get that out and get that out to my clients and let them know that's something that's available. And then I can refer you to other very knowledgeable financial and accounting professionals that are well-versed in 401ks and higher level retirement plans, if that's also something that you want to do. And there are some very interesting things out there, especially for us who need to do some catch-up retirement investing. All right, very good.